Good morning, good morning, good morning, everyone. My name is Don Daniel, founder of Pill Method International, a better way to eliminate debt. And we are going to be talking about student loans today, student loan larceny. So not only do we help people get out of debt with their mortgages, but student loans as well. Do you know I meet people who have mortgages and student loans and credit card debt and auto loans, and they could get it all done, all paid off in an average of 7 to 9 years. I said, well, Don, what about somebody who, financed their whole, educational pursuits on student loans and they became a doctor or a lawyer? Oh man. Oh, you talk about expense. Yes, even them. Their mortgages and their student loans in an average of 5 to 7 years. I've got some doctors that's going to be completely debt free in about 5 years. I'm telling you, it's crazy how all of this works, about how much interest you are paying, and it keeps you in debt forever. Oh my gosh. All right, Miss Credit Goddess, how are you doing this morning? What are you doing? What's up?
I'm awesome. Happy Friday.
Listen, why don't you just go ahead and introduce yourself and tell the folks how fabulous you are.
Absolutely. Happy Friday, everyone. My name is Rosalore Lewis, also known as Credit Goddess. I'm all things credit and the official credit expert for the Pill Method crew here. I'm a credit score improvement strategist. So not only do I help you repair, which you can do on your own, but I also help you rebuild, and that's education. Helping you how to optimize your credit, improve your credit, so that way you can gain access to other people's money. Although we're talking about how to pay off your debts, but it's how to borrow money cheap, right? Saving money on interest. So credit is a tool, you guys, and we need that in our toolbox. I'm also a business credit consultant. If you're an entrepreneur looking to start up your business and you need startup funding instead of having to bootstrap with your own funds, definitely tap in with me. Let's get that going. And I'm also an educator at Be Free University. We have already launched, and we're accepting students. Not only will you learn credit, but you'll learn business, you'll learn trading, you'll learn taxes, you'll learn everything financial. So definitely tap in with me if you're interested. But thank you, Don.
You're so welcome. You're so welcome. Listen, folks, if you are in the audience, if you are a Pill Method client and you want to come up to the stage and just say a little word, just say a little word about your experience with the Pill Method, that would be wonderful. People want to hear from you if you're already experiencing the benefits of the Pill Method. Just raise your hand. If you have any questions about student loans, raise your hand now. Get on up here. So, Miss Dion, come on up to the stage here. Let me invite you to speak. And listen, we're going to get some folks up here. Miss Dion, how are you doing this morning?
Good morning, Mr. Don. Good morning, Credit Goddess. I'm doing well, thank you.
So,
Hello.
what brings you to the stage today?
Yep, I am a current client. My husband and I just signed up a little over less than 30 days, I want to say, but the onboarding has been phenomenal, and we're just still mind blown with the math. The math is mathing with the pill method, and then we're just absolutely blown away at the possibilities. And I'm in awe right now, and I just can't wait to see what happens in the next 60 to 90 days.
So, Miss Dion, I got a couple of questions for you. So, I mean, most people only if they come to this app or watch me online, because we're on YouTube, Twitter, LinkedIn, and Facebook. Okay, so they can actually watch us there, and they see me all the time. So, is there actually a Pill Method staff out there?
Aside, I mean, you have a team, a wonderful team. I can always reach out if I have any questions to ask anyone at any time, of course, during business hours, but we are not alone. If I have any questions, you've been, very gracious with your time, and I can get on your calendar and speak to you or your team or support at any time.
So, when you call support, do you get a recording, or somebody answer the phone?
Oh, no, live person. Live
Okay.
person every time.
Every time. Listen, Deanna, listen, thank you so much for coming to the stage and sharing with us. Do you have anything else you'd like to share before we go ahead and dive into student loans today?
Oh, no, sir. Just can't wait to listen in and share, these tips with someone I know that may have student loans. Like I said in the chat, my kids were blessed. My husband and I are retired military, so they both have our GI Bill. And our kids, were very fortunate enough to, graduate from college with zero debt. So thank you so much for letting me share. I'm going to move myself back down to the audience.
All right. Thank you for coming up to share. Folks, if you have questions about student loans, or if you're a current Pill Method client, you want to come up and share, please feel free. But come up here, raise your hand to get on stage and talk about these student loans. I'm going to dive right in, but we have 8 shares. Listen, there are other people out there that want to hear about student loans. We have 8 shares. And so I'm going to ask a favor. I'm going to ask you to follow me. I'm going to also ask you to share the room. Why are we asking you to share the room? Because when you share the room, it goes out into your hallway and other people can see the title of this room, not just how to pay off mortgages in 7 years, but talking about student loan larceny and how all of that works. Oh man, we're up to 9 shares. Thank you so much, everybody. Come on, get it in there, get it in there. And so to get some energy in the room, if you want to know more about student loans, all right, if you want to tell somebody else about student loans, can I get some number 9s in the chat? Number 9s in the chat. Put number 9s in the chat if you think this is an important topic so that I can get some energy up so we can go, oh my goodness, here they come, here they come. I love to see that when we have people participate in everything. So come on, folks, put those number 9s in the chat. Go ahead, share the room. And so people can get in here to hear what we've got to talk about. So now I'm going to lay a foundation here. We're going to start out with an example. I'm going to put on the screen an example here, but the example has to do with understanding how an amortization schedule works. I'm going to use a mortgage as our example, and then we're going to get into how it all works for student loans. Okay? I want you to be able to see that first. So what we're going to do here is get that on the screen, get this off my screen, and then share this thing. All right. So we're going to share the screen here. All right. Share the screen. Boom, boom. All right. There we go. All right. So now here's what we're going to do, folks. Let me go back in here and see if there's anybody else who wants to come to the stage just yet. And credit guys, you're going to keep an eye out for me. And the eye on the chat in case there's a question in there. Listen, folks, student loan larceny. That's what we're going to talk about today. You know, people with student loans, help them to understand how these loans work. And you'll be able, not only that, but you're able to see what we're talking about this morning. How do you see it? If you're on Clubhouse, well, if you have a tablet or a computer, or a desktop or whatever, then you can type in to your browser ice10kvideos.com. ice10kvideos.com. That will take you to our YouTube channel. And that's ice, the number 10, the letter K, videos with an S.com. And that way you can actually see what we're talking about and hear us on Clubhouse. And if you want to participate, this is a perfect forum to participate and ask all of your questions. Do you have a burning question as to why student loans are hanging around forever? Do you know, I know people who graduated from college 20 years ago. They still have their student loans. Do you know, I have people who have been paying faithfully every month on their student loans for 20 years, and they owe more now than they did when they graduated and they haven't taken another class? How is it that you can pay faithfully every single month for 20 years and owe more now than you did when you graduated? Oh my goodness. Listen, raise your hand. If you know anybody like that, come up to the stage, ask your questions. I'll be glad to go over all of that with you. But for now, we are going to put this on the screen and get started today. So let's get some basics in here, okay? We'll put the basics on the screen. How to pay off mortgages and all other debt in about 7 years. That's what's on the screen right now. So let's go ahead and get started. And as we do that, go ahead, raise your hand. And if you want to ask a question, stop me at any time. All right. So here's what we're talking about, folks. The P.I.L.L method. We're on Clubhouse right now. We're also on Facebook, LinkedIn, YouTube, and Twitter. If you want to know more about this, if you can see this screen, go ahead, take out your phone and then scan this QR code to get my 10K card. You can have my 10K card. You can download it. And put it right on your home screen by following the directions. All righty. All right. Or you can just type in ice10k.com. And you see here is our website, pillmethod.com. So you have ice10k.com, which is my business card, and you have our website, pillmethod.com, on the screen right now. All right, so we're also talking about my book is on the screen right now. It is the only book on Amazon out of 33 million titles that talks about this subject, how to get rid of these loans cheaper and faster. What is the bank doing that we don't know about that keeps these loans around forever when we could have them dispatched with your current budget in 5 to 7 years? Most people get rid of their student loans with us in 5 to 7 years. Most people do. All right. So let's get in here. 90% of the people all right, will never be out of debt. 90% of the people will never be out of debt. This is why we're into this right now. 30-year loans, mortgages, student loans, or whatever should pay off in about 7 to 9 years. That's with everything. But student loans typically are done in 5 to 7 years. You can do all of this without refinancing, without change to your budget, and without sacrificing lifestyle. What does that mean, folks? Without sacrificing lifestyle. There are people out there right now that are teaching you can't go anywhere. You can't do anything. You can't live a good life. You have to live like a pauper and take all of your money and throw it at the debt. Not only that, but you got to take extra time away from your family and get a part-time job on top of your regular job just to pay off the debt. Now, there are plans like that, but we don't like those plans. All right. If you like a plan, if you don't like that plan, put a number 1 in the chat. If you don't like the plan that says, I got to take time away from my family, I can't go anywhere, I can't do anything, and I got to take all of my money and throw it at the debt. And if you don't like that plan, put a number 1 in the chat. If you do not like that plan, put a number 1 in the chat. We don't like that plan. We don't like that plan. We want a better plan. All right. There you go. Here come those number ones. Here come those number ones. We want a better plan. I don't want to have to sacrifice lifestyle just to get out of debt. If you're watching us online, if you want to be able to see this, go to ice10kvideos.com so that you can see what we're talking about here. So here's where you will not hear this information, folks. You're not going to get this information from your accountant or from your financial planner or from your banker. You're not going to get this information. You also will not get this information from popular financial gurus like Dave Ramsey, Susie Orman, Gene Chatsky, or Larry Burkett. And there's a very good reason why you will not get this information from these sources, is because the information that you're going to get here is only found here. We didn't go to YouTube University and glean a lot of stuff from other people and regurgitate it. This information is here and only here with the P.I.L.L method, because I literally wrote the book on the subject. Now, how did I get to this knowledge? It wasn't because I'm smart. it's because I have Asperger's. It's because I'm autistic. And so when I look at all of this, I see the patterns and the pictures, and that's how my brain works. And I said the pattern and the way that they're asking us to pay the debt is the most inefficient way possible. But if you just change the pattern, if you just change how they are asking us to do it this way and then change it that way, it saves a ton of interest. And I'm going to be glad to go over that with you today. All right, folks, here we go. What's next? We're going to, how do you defeat this whole thing? All right. We need to be able to read an amortization schedule. And reading an amortization schedule is not taught at any level of financial education. We're at 10 shares in the room. So go ahead and start bringing some more people in so that you can know more about how to get rid of these student loans. All right. So here is what P.I.L.L method stands for: prepayment of principal, isolating the principal amount, leverage, and liquidity. I need you to see this formula. All right. This is how the banks amortize loans, with this formula. You know, it was Albert Einstein who said, compound interest is the eighth wonder of the world, but amortized interest must be the ninth. So what do we do here? Let's learn how to read an amortization schedule. Are you ready? All right. So the first thing you need to know is this: the borrower's right to prepay. The borrower's right to prepay. So you have the right to make principal payments at any time before they're due. You can put money on a debt before it's due, and that's known as a prepayment. That's going to be number one. So if you want, please write prepayment in the chat. Prepayment in the chat. That's going to be the key to all of this. Now, remember, you don't need more money to get out of debt. We just need to manage what you have in a different way. We just need it to do it a different way with what you have. You don't need more. You just need to pay less interest, and we're going to go over that. When making a prepayment, listen to this, folks. When you make a prepayment, all you have to do is tell the note holder in writing that you're doing so. Now, however they want to be informed, each lender has their own rules about prepayment. So follow the rules when you're making a prepayment, and you're going to be fine. Do not assume that one lender, the way you prepay, that all lenders accept prepayments the same way. They don't. So find out what they're talking about, and then do what they're asking you to do. And guess what? You're going to be able to do it without a prepayment charge. All right. So, there we go. There we go. All right. So folks, the note holder, here's the key, crucial part. The note holder will use all of my prepayments to reduce the amount of principal I owe under this note. So all of your prepayments go to reduce the principal, the amount borrowed. And by doing that, you save interest. Okay. So let's go ahead, and I'm going to put a $200,000 mortgage on the screen, and we're going to use this as our example to learn how to read an amortization schedule. And then we'll get into how all of this works for student loans. The amortization schedule is the same on all amortized loans. The formula is the same. Now, a different type of loan may have different rules, but the basic formula is the same worldwide. All right. So by understanding that, you can then understand the basics of how to get rid of this. So we have a $200,000 mortgage at 6%, and it's a 30-year term. The payment is $1199.10. Here is how much interest the bank wants on this loan. $200,000. They want $231,676 in interest on this 30-year loan. That's not 6%, folks. That's 115.838%. 115.838%. And they can get away with calling it 6%. Oh my goodness. So what are we doing about that? Let's learn. Let's learn today. I have on the screen the entire payment of $1,199.10. But the very first payment, all right, the very first payment is only $199.10 goes to principal and $1,000 goes to interest. They have a payment of that's nearly $1,200, folks. And out of that money, only $199.10 goes to the loan, $1,000 goes to interest. And this is how it works. We subtract the $199.10 from what we owe, and we're left with the principal balance of $199,800.90. The bank uses the principal balance on any line to tell you how much interest you owe on the next line. All right. So listen, right now, we're almost at the bottom of the hour. We're almost at the bottom of the hour. And while I get a drink of water here, folks, because Miss Credit Goddess, are you there?
I am.
Listen, do you work with people who have student loans?
Oh yeah.
All right. And so and do you have people that misunderstand their student loans and think that they can't get a mortgage or they can't do stuff because they have student loans? What do you tell people who have student loans and give them a proper understanding about what they can and cannot do if they have student loans? Could you do that while I get a drink of water, please?
Yeah. Sure. So I get a lot of people that think that because they have student loans that they cannot purchase a home. I work closely with realtors and mortgage brokers, because they send them clients to me, especially if their credit is not where it needs to be to qualify for a home. Okay, so here's an understanding. When we're talking about credit, there's different types of credit. You have credit cards, which are revolving accounts. You have installment loans, which are auto loans, student loans, right? Personal loans. And then you have the mortgage. I call that the trifecta. Now, when we are looking into debt, we have to also take in consideration our income, right? So when we're applying for a mortgage, not only do they look at your credit score, they also look at your debts. And this is how, and they calculate your debt against your income. A lot of people count themselves out because they have this high student loan balance or this high student loan debt, and they count themselves out thinking that they cannot get approved for a mortgage because of the fact, and this is me outside looking in, and I hear you guys talk, I hear you guys share information on all these social media platforms. When you find a person that say, "Oh, I didn't qualify because I have student loans," but here is why most people or some people do not qualify is because their debt to income ratio. When lenders look at your debt to income ratio, you cannot go over a certain percentage. Like some lenders will say your debt cannot exceed 43% of your income or 50% of your income. So let me give you guys this formula to determine if you are right there at the debt to income ratio guideline. So some say 43% you don't want to be over and 50%. You take all of your debts, and I'm not talking about the total debt. I'm talking about your monthly debt. Okay, so, and then I'm going to touch on the monthly debt for those of you guys that are not making payments on your student loans. Okay, so they take all of your debts, your credit card debt, your loan debts, any debt, not your rent if you're renting, because that's not considered debt. Is anything that you're borrowing, that you borrowed and you're paying back on a monthly basis. They calculate all of that, take all of that balance, and then divide it by your total income that you're making monthly, that you bring home monthly. And that's plus taxes. That's including the tax. So once you do that, then you'll get the percentage, right? So let's do easy math. All of your debts equal up to 2,500, and that's including your student loans. 2,500 divided by, say, $5,000 a month that you that your monthly income, that puts you at 50% debt to income ratio. Okay, so you're right there. Now, the reason why they do this, because when you're trying to apply for a mortgage, they just want to be able to know that you'll be able to afford the mortgage payment, because we got to add that on top of the current debts that you already have. So if it's pushing you to the point where, okay, you're over the 50%, I don't think you will be able to afford this debt. Or sometime you may not be able to afford the maximum loan for the mortgage. You know, some of you guys maybe your budget is probably 200,000 and you want a home that's 350,000, but based on your debt to income ratio, you may not be able to afford a $350,000 home, so they'll give you a budget of 200,000. And a lot of times people count themselves out of that, saying, I can't find a home within the $200,000 ratio. And this is why a lot of people count themselves out again when they say the prices of the homes are too high. Okay, but if it's just your income, you may need to come in and bring another, a co-borrower, a co-signer, someone that will also bring their income to the table and their credit, so that way you can afford that $350,000 home. Now, for those of you guys that have student loans that you are not making payments on, say for instance, it's in deferment or it's in forbearance, and I do get clients that have loans in default. Let's talk about the ones that are in forbearance and deferment. If you're not making payments on that, they need to determine how much of that the monthly payment of your student loans be included. So they want to include your student loans even though you're not making payments on it. It used to be 1% of the total balance of your student loans. Like, say for instance, you owe 100,000, 1% of it is 1,000. They used to take 1,000 and add that to your debt to income ratio. Now they cut that in half. It's a 0.5%. So instead of 1,000, now it's 500 they will put towards your debt to income ratio if your loans are in deferment or if it's in forbearance.
Wait a
Just to
second.
include that,
Wait.
just in case you do get that home and then the repayment starts, it's not going to push you over the limit to the point where you're eeny, meeny, miny, mo, which bill got to go, and then your either your mortgage will be, at risk, or your student loans will be at risk, or something. Any debt will be at risk and will put you in position to maybe go into foreclosure or
Wait a
whatever
second,
the case
credit
is.
goddess. Wait a second.
Yeah.
You just
Yeah.
said something here.
Uh-huh.
Because of the debt to income ratio, because you talked about a rule change on how student loans figure into debt to income ratio, because they have been turned down for a loan under the old rules, they should go ahead and see how their debt to income ratio has changed, because under these new rules, they can reapply. And those people who got turned down before, a lot of those people can get approved now because of the new rules. Is that right?
That is absolutely correct.
Oh my goodness. I just wanted to tap in there. Keep going, credit guys. You're doing a good job. We need this background information on student loans and what we can. I help you to get rid of them, but Credit Goddess is going to help you to negotiate around them to get what you need sooner. You don't have to pay off the loans to get a mortgage or something. You just need to know how it all fits in, and then we can talk about getting rid of them. Go ahead, Credit Goddess. Talk to us.
Absolutely. Yeah, so don't count yourself out because of that. because now they have lowered that to 0.5%. So if you owe 100,000, 0.5% of your total balance on a monthly basis is $500. So if you don't have a lot of credit card debt and student loans is the only thing that you have, or maybe a card note that's probably like 400 and some dollars a month, add that on top of that. That's putting you no more than 1,000 a month towards your debt to income ratio. And if you make $5,000 a month, $1,000, and then divide that by 5,000 will put you where? 20%. So you can afford a mortgage. Okay. So don't count yourself out. Now, those that are counting themselves out as far as credit is concerned, don't count yourself out there. Now, the reason that you want to improve your credit is so that way you can get the best interest rate and the best term. You can negotiate your terms. But Don talks about how even if you have bad credit and you don't get the best rate and the best term, how that is cheaper if you are planning to pay off your loan in a shorter period of time as opposed to a 30-year term. If you're planning on paying off the loan in 7 years, 9 years, as we talk about here, go ahead and get that high interest loan. It doesn't matter, you know? So I'm just mentioning all of this so that way it can give you the options. Don't count yourself out. Just get in the game. Just get in the game so that way we can start building generational wealth and we can pass something down to our children, and our children don't have to go through what we're going through now. You want to get them started early, you know, teach them about financial literacy, teach them about student loans. I know a lot of us are looking at these student loans as an eyesore, but teach them about that. Put them in position to have good credit so that way they're not hit with these high interest rates on these student loans. Because let me tell you, many of us, and I'm talking about us of color, the many loans that I've seen, we're paying 6.9%, 7.8% on our student loans when the other counterparts are paying 3%, 2.4% on their loans. And why? Is because at the time that you apply for the student loans, it all was based on your credit. So if you had good credit then you were given a lower interest rate. If you did not have good credit then you were given a high interest rate. So that is killing our pockets, borrowing money on bad credit. And then two, what Don is going to share with you, why some people take forever to pay off their student loans because of the interest rate that accrues over time. Okay, so if we're being charged higher interest rates, the interest rate is going to accrue over time, and we're going to end up owing more and more and more year after year after year. So you want to tackle those student loans so that way you can save on the interest costs over time throughout the year. So I'm gonna yield the mic and give it back to Don. But I hope you guys understand. And if you guys have any questions, I am here to answer them.
So here's what I got out of that, folks. Don't let student loans keep you from living your life. Get information from an expert and see how we can live with the student loans to get where you need to go. And if there are any changes that need to be made, get the changes from an expert. Okay. And that way you'll be able to get your home faster. You'll be able to start your family faster because you're doing it based on good information, based on the math. Is that what I'm hearing, Credit Goddess?
Absolutely.
All right.
And,
how do they tap in with you? How do they tap in with you to get to learn more about how you can help them negotiate and live with their student loans?
Well, you guys can tap in with me with the number in the bio. It is 888-557-5778. It's easy to remember. 888-557-5778. Send your name and email address there. A link will pop up where you can book your consultation. If I have any time today to speak to someone, just let me know that at what time that you're available, and I'll hop on a call with you and tell you about my programs and how I can assist. But I do want to address Dr. Khadijah. Thank you for engaging in a chat here. She said, my solution is getting them taken off of the credit report so you can pay them as you need to without being judged because you have them. Now, I do want to say, just because it's off your credit report it doesn't mean that they cannot locate them. There is over 50 credit reporting agencies. We know about the three big: Experian, TransUnion, Equifax, but there are other third-party data reporting agency, and that one that reports all government loans and government programs is CAIVRS. That's CAIVRS. CAIVRS document anything related to the government, which is like FHA loan and also student loans. So mortgage lenders, they pull from CAIVRS to see if you have any government related loans, whether it's FHA or student loans, and they can see that. And if they see that you do have a student loan, whether it's in default or if it was taken off your credit report and it's just not seen there, they will pull from there and they will use those numbers, same numbers that they will find on your credit report. So no, there's no way of hiding. There's so many other data reporting agencies that they can pull from just to make sure if it's not reporting on all three. So just want to make that clear. And two, yeah, because of the fact that people are going through credit repair and getting things taken off their credit, they can still locate them. So just take care of your debts, take care of your bills, make sure that you pay on time, because even though you go through credit repair, they can still find them, especially if you're trying to go for a mortgage. So help them make it clear.
All right, credit guys. Here's what I'm understanding from this is that if you're a mortgage professional, all right, and when you have a certain number of mortgages out there, and you start having defaults, I mean, people who can't pay their mortgages, all right, and if they find out that this mortgage company didn't check with CAIVRS and said that this person was completely delinquent on their student loans. Okay. So talk to us. It's inconceivable that a mortgage company is not going to check that because they need to protect their ability to lend, correct?
Absolutely. Yes. That's their fiduciary duty. Yes, they have to protect, because if they don't do that and you default and they find that you did not do your due diligence as a mortgage broker or MLO, yes, you can be in serious trouble.
All right. Thank you very much, Credit Goddess. Listen, folks, we're going to continue right after this word and here's the word I want to share with you right now. Did you realize that there are people out there that get rid of their loans in 5 to 7 years? I know somebody who got rid of their mortgage and other debt in about 4 years. And some of you have actually heard of this individual. Yes, I'm talking about the hip hop preacher, E.T., the hip hop preacher, Dr. Eric Thomas. And here's what he had to say about getting rid of his debt in about 4 years. Let's roll it.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
All right, folks, listen, here's what we're going to do. Here's where we are now. I have we're going to learn how to read an amortization schedule using this form, and then once we learn how to read it, we're going to talk about student loans. So we have a mortgage of $200,000 at 6% for 30 years. The payment is $1199.10, and in the very first month, $199.10 goes to principal, $1,000 goes to interest. We have a principal balance of $199,800.90. The bank uses the principal balance on any line to figure out how much interest you pay on the very next line. That's all you have to remember. Where am I in my principal balance? And so how much interest will I pay on the very next line? All right. So watch this. So if we make our very first payment here in January, we make a payment in January, and then $199.10 goes to principal. Then our next payment in February, $200.10 goes to principal, and $999 in interest goes to the bank. And we're paid down to $199,600.80. So let's take a look at this thing. Let's say you make that first payment in January. You can take a look at your February principal payment of $200.10. Here's the question. Do we have to wait till February to give the bank that money? The answer is no. If we prepay it, give it to the bank early, then we can not only, number two payment is completely eradicated. We save $999 in interest, and our next mortgage payment for February is actually on line 3 of the schedule. And it looks a little like this. We get rid of $999 in interest we never have to pay because of how we disrupted the bank's timing. Do you see that? Now watch what happens if you do this. What if we not only pay, not just one principal payment, but we make our regular mortgage payment. Let's say we pay the next 3. That would be $200.10, $201.10, and $202.10. I've got 14 shares in here right now. Can we get up to 20 shares? Because we're getting into the meat of this thing. I'm giving you the basics, and so that you will be able to see how to read these student loans and keep them from killing us, because that's exactly what's going to happen. Why don't you go ahead, take a look at this, and if you're new to the room, go to ice10kvideos.com, ice10kvideos.com, and go straight to our YouTube channel and subscribe, and you can see what we're talking about here. You can listen to us on Clubhouse. Just pull out your tablet or your computer and just type into the browser ICE, the number 10, the letter K, videos.com, and it will take you to our YouTube channel. You can see this. We're making a payment number 1 in January, but we're looking at the principal payments for February, March, and April. That's $200.10, $201.10, and $202.10. What if we gave that to the bank ahead of time? What if we gave that to the bank in January as well? That's $603.30. Do you realize that we knock off 3 payments we never have to make, and we kill approximately $3,000 in interest we never need to pay? Folks, those are the basics. So let's get some more people in here. Now we're going to pull up what we call student loan larceny, now that you have the basics. Are you ready? All right. If you're ready to see how we can get rid of these student loans, go ahead, put some number 9s in the chat so that you can be able to see student loan larceny. Let me see the number 9s in the chat. Come on, folks. You want to get this information, how we can get rid of these student loans in 5 to 7 years instead of never. I mean, I've got people who are paying more now than they owe more now than they did when they graduated. And here's why. That kind of loan is called a negatively amortized loan. A negatively amortized loan. You see on your screen right now, student loan larceny. Let's talk about those people who owe more now than they did when they graduated 5, 10, 15, or 20 years ago. They owe more now on their student loans than they did when they graduated. It is because of a negatively amortized loan. Have you ever heard of an income-based payment? An income-based payment. When you have an income-based payment, often your payment is less than the interest amount that would be owed that month. You see, when you get a new payment, they don't rework the loan. Your interest rate stays the same. The amortization schedule stays the same. The only thing that changes is they change your payment. If you should be paying $300 a month, all right, and $200 goes to interest, All right. So that's $300 a month and $200 of it goes to interest. Let's just say that's where you are. What if they change your payment, okay, to $100 a month? What if it's just $100 a month? Guess what? You're supposed to be paying at least $200 a month in interest, but they change your payment to $100 a month, which does not cover all of the interest. So what happens to the interest that didn't get paid that month? This is what happened to it. They add the interest that you didn't pay to the principal of the loan. So your loan actually grows by another $100. Every time you don't pay all of the interest, they take the unpaid interest and add it to the loan. That's called capitalization. And how they do that, what that means is you start to pay interest on your interest. Oh, no. Are you kidding me? You start to pay interest on your interest so that not only you'll never pay off that loan, never. In fact, it'll get so large that you'll just keep paying that interest forever. Now, why would a company ever put themselves in a position where you could never, ever pay off the loan? Do you see that most student loans are government-backed loans, but the government doesn't administer the student loan program. They don't administer it. They go to private companies who administer it, who administer the and look over the student loans. And the private companies offer you government-backed money. So here's what's happening. Oh my gosh. The student loan company will lend you money, but the government guarantees that the company that loaned you the money guarantees that they're going to get their money back. Do you realize that some of these companies that keep sending you a student loan bill for the money that you borrowed, these companies have already been paid because you signed a note that you would pay this money and the interest involved? You still owe the money, even though that entity has already been paid with government money that covers the student loan program. This is why a person with no job, oh my gosh, a person with no job and in school never gets turned down for a student loan. But could you go out and get a car like that? Could you go out and buy a house like that? How can you get $100,000, $200,000, $300,000, $400,000 in student loan money on your signature as an 18-year-old, 19-year-old, 20-year-old? Why? Because it's a government-backed program that guarantees that the people issuing the money will get their money back. So any extra money they get from you is just gravy. That's why they'll give you a loan payment that will never pay off the loan, because they've already been paid. How many of you knew that? How many of you didn't know that? Oh my gosh. So here's what's going to happen, folks. We're going to get into this thing and we're going to learn how this student loan larceny can stop for you. Do we have any questions out there? Oh, come on, we got 14 shares about this. And listen, these student loan companies are taking advantage of the fact that we don't understand how they work. You're going to learn the secrets of how they work right now. So please go to ice10kvideos.com and so that you can see this. Or listen, if you're driving or at work, see the replays later, and then share that with your family and friends. Student loan larceny, folks, here we go. I met a student here not too long ago here in Huntsville, Alabama, that graduated from Oakwood University with $9,500 in interest. $9,500, not $95,000, only $9,500 in student loan debt. $9,500 at 6%. They received a payment of $50 a month at 6%. So this was their payment because they're just out of school. They weren't in their job that was making a whole lot of money yet. So they got a payment of $50 a month, and they were happy with that $50 a month payment, but they wanted to get a car. So they came to me and said, Mr. Don, how can I get a car so I can get back and forth to work and pay off my student loan? I said, first of all, with $9,500, how long should it take you to pay off this student loan at $50 a month? I need some guesses in the chat. I need some people to come to the stage or put it in the chat. How long do you think it should take to pay off $9,500 at $50 a month? I'm taking all guesses. How many want to take a guess here? Put it in the chat or come to the stage. Raise your hand or put it in the chat. All right. How long should it take to pay that off? All right. We have somebody who wants to come. All right. There we go. All right. Dr. Barbecue, how are you doing, sir?
Good morning, Lance. Good morning. How you doing?
I'm doing right, man. I'm doing all right, man. So do you have a guess? Do you have, go ahead.
$900.
Yeah.
1 year, 3 months.
1 year, 3 months. Okay, that's a pretty good guess. All right. Do you have any other guesses? I got 1 year, 3 months, $9,500, $50 a month at 6% interest. Do I have any other guesses? Put it in the chat or come to the stage. So, Dr. Barbecue, we want you to hang around just in case you got another question or comment, okay?
Yes, sir.
All right, all right. All right, what? No other guesses? Oh, my goodness. Come on. Let me list one more guess. Now, I'm not asking you to do any math. This is just a pure guess, all right? And when you guess, there can be no wrong answer, all right? It's just a guess. How long should it take to pay off $9,500 at $50 a month? Anybody? So I've got 1 year, 6 months. All right. Anybody else? I guess nobody else wants to guess. Okay. All right. I got Jeremiah Sams online. He says his guess is 60 years. Okay. So I got 1 year, 6 months, and I got Jeremiah Sams online saying 60 years. Let's take a look at this. Here we go, folks. How many years? So $9,500 at $50 a month comes to 601 payments. If you divide 601 payments by 12, it comes to 50 years. 50 years. All right. So Tisha said 20 years. Tisha, you're closer. 50 years to pay off $9,500. Here's what it looks like, folks. Here's what it looks like. This is why we need to know what we need to know. All right. Here's how much interest the bank will charge on this loan of $9,500 at $50 a month. They want this student to pay them $20,550 in interest. What? $20,550 in interest on this loan, which makes the total interest paid as a percentage of principal 216.316%. Folks, is that student loan larceny or what? Somebody put that in the chat. Student loan larceny. Is that student loan larceny or what? So let's break down how this payment. Okay. Jeremiah Sam says he was close. Yeah, you were close, brother. You were close. Lena says, what? Oh my gosh. So listen, remember what you learned about the mortgage information, and we'll see how we can take advantage of this student loan situation before the student loan situation takes advantage of us. So here's what we're looking at, folks. On the very first payment of $50 a month, do you see how much goes to principal? $2.50 out of $2.50 out of a $50 payment. Only $2.50 pays down the loan. I need somebody to put in the chat $2.50. $2.50. That's it. Okay. Onyx Boss says, that's crazy. I know it's crazy. I know it's crazy. That's why we need to pay attention here. So put $2.50 in the chat, folks. That's all out of that $50 that goes to the loan company. $2.50 goes to principal. Here's what we look at. And how much goes to interest? $47.50 goes to interest. So out of your $50 payment, there you go, Miss Lena. Out of your $50 payment, how much goes to interest? I need people to put in the chat $47.50. $47.50 out of that $50 payment. Write it up. Write it up. Put it in the chat. $47.50 out of that payment goes to principal. And I need you to take a look at we have $47 payments going all the way down. Look at that. And the next month, it only changes by a penny. $2.51 goes to principal and $47.49 goes to interest. And the next month, it only changes by 2 more pennies. What in the world is going on here? Is this legal? You better believe it's legal. You better believe it's legal. Johnny Bling says that's robbery. I know this is why we call it student loan larceny. Student loan larceny if you don't know how to read this amortization schedule. So now that we've learned what we've learned, let's just say we make our first student loan payment in January of $50 a month. So if I take a look at this thing, the next payment for February would be $2.51 going to principal. So could I make my January payment and then give the bank an extra $2.51? Could I scratch up $2.51 and apply that to my loan payment? Pay that extra $2.51 anywhere in January. Can I do that? Yeah, you can. And guess what happens? You completely eliminate line 2 from your student loan. Line 2 is gone. And the interest you would have paid, $47.49, that's gone too. You just canceled $47.49 in interest you never have to pay. Wow. Anybody got any comments on that? What happened to, oh man, he left. I was going to ask him a question. Folks, what do you think about that? $2, just an extra $2.51. Look at this. Look at what happens. We're going to put it on the screen. $2.51 prepaid eliminates that $47.49 in interest you never have to pay. Oh man, we're going to take another look at this. What happens? Do you see on the screen right now that if we take a look at column 3, that's cumulative principal, and look at line 12. In 1 year, this loan pays down only by $30.84. $30.84. Let me ask you folks, if you know you're going to pay $30.84 towards this loan, do you have to pay it in 12 monthly installments? Could I just give the bank the $30.84 on line 1 and be paid down to line 12 in just 1 month? Could I do that? And how much interest would I save if I did that? How much interest would I save if I did that? I left my, I got I messed up my stream. Can we bring it back? That was my fault, sir. All right, there we go. All right, so, all right, let me bring this back so I can see. Okay, I can see what's going on. All right, $30.84 in 1 year. Look at that. $34.84. If I could prepay that, I'm brought down to pay on line 12 on my amortization schedule. And guess what happens? I save out of all the interest between line 2 and line 12, gone, eliminated. All of that interest by giving the bank the $34.84 all at one time. Did anybody know that your student loans work like this? Man, oh man. Here's what I need you to see. Here's what I need you to see. I teach people not to be afraid of student loans because you can borrow the money at a great discount. You can borrow the money at a discount and pay them off in 5 to 7 years. And for you parents who can afford to stroke a check for your student, let me share something with you. Okay? No, you can't get the live screen on Clubhouse, sir. Yeah. You gotta go to YouTube or Twitter or LinkedIn or Facebook to be able to see what we're talking about. But folks, here's what we need to do. I'm going to give you a bit of advice for those of you who are fortunate to be able to write a check and not use student loans. Guess what? You should be using student loans. I'll say it one more time. Even those parents who are in a financial position to write a check for their child's tuition, you still should be using student loans. Why is that? Okay. Do I see any reaction to that? Is there any reaction to why we should be using student loans even if we can afford to pay cash? Here's why. I had a doctor that right here in Huntsville, Alabama, was writing checks for getting ready to write a check for their child's first semester at Oakwood University. All right. They're getting ready to write a check. And I said, had you considered student loans? And they said, well, why would I? I can write a check. I said, well, when do you have to pay back the student loans? When do they start looking for their money? And the doctor said, when she graduates. When she graduates. So are you saying that you don't have to make any payments or anything? You're good for that? Says, yeah. I said, well, what if you did this? Instead of, and do you realize that they don't even start charging interest on these loans until then, right? They don't even start charging interest until it's time to start paying. They give you the money. On most of these loans, you don't start paying interest until it's time to start paying 4 years later at graduation. So I said, what if you took that check and put it in a safe investment and then got student loans for your child? So now the tuition gets paid, you're not paying any interest, and the money you would have spent on the tuition is now in an investment making money for you. And then you do that the second semester, and then you do that the second year, and then the third year, and then the fourth year. We're putting that money into an investment. And then when the student loans come due, take that money out of your investment. You keep everything that you've earned and you pay the student loans off in one shot, not paying any interest. Does anybody have anything to say about that strategy? What do you guys think about that? All right. Have we learned something today? How can we use a strategy once we understand how student loans work? All right. So now what if you're not fortunate enough to be able to do that? What if you want to pay off your loan in 5 to 7 years? Look what we did with $30.84 here, folks. With $30.84, we completely demolished 1 year worth of student loan payments. And what did we do? Saved over $500 in interest. Saved over $500 in interest. We did. Come on here. We've got Miss Coffee Brown. Miss Coffee Brown, where have you been this morning? We've been waiting on you.
Pastor Don, sometimes I get in the sanctuary a little late. Please pardon my tardiness on this morning, Pastor Don. Good morning, everybody.
Every time I turn around, you're giving me a promotion.
First it was
I know,
Deacon
right?
Don, then it was Rem Don, and then it was Dr. Don, now it's Pastor Don.
All right. Coffee Brown, tell us who you are. Oh, she got a phone call. All right. Let's get her back in there so she can. I had somebody raise their hand, Miss Olivia. Let's bring you up to the stage, Miss Olivia. Invite you to speak. So go ahead and answer that and come on up to the stage. We'll get Coffee Brown to introduce herself when she gets off the phone. Miss Olivia raised her hand, and I hope she wanted to come to the stage and ask a question. So anyway, you've been invited. All right. Stack, what's up, man? Come on up. All right.
Ice, I had to come support my brother. Pay off your mortgages in 7 years. Let's go.
Now we're talking about student loans, man. Paying those off in about 5.
Okay. So let's get into it. I'm just here to support my brother. What's going on?
All right, man. Listen, I appreciate you so much. But while we're doing that, listen, I could go ahead and use let me get a drink of water while you introduce yourself and tell us who you are, Stack.
I got you, Ice. If you guys don't know who I am, I'm Stack Pack. I'm the CEO of Internet Traffic. So I own a worldwide digital marketing company where I help a lot of clients and entrepreneurs and brands grow online on every single platform on the planet. Doesn't matter which one you're on, Instagram, Facebook, TikTok. I get a lot of brands from zero to hero real fast. I'm heavily invested into NFTs, the metaverse. I'm the owner of Stacking Deeds Investment Group. So we do a lot of tax deeds and investments. And I just closed my first lending partnership agreement with NBC. So that's National Business Capital. So I'm able to do a lot of funding for a lot of businesses. So if you know any businesses out there, you guys can contact my team and we'll get you guys set up to see if you guys can get approved in less than 24 hours if you meet the requirements. So I'm here. I help with social media. I help with branding. I get you to the next level. I get people on digital billboard placements, and I also get them featured on a lot of different digital magazines across the internet. So I'm here to support ICE. I'm here for the community. I'm here to, listen to the gems. And if you guys need my assistance, just shoot me a back channel, or you guys can go to stackpackmedia.com and book a call, or just text the number in my bio if you want to, get set up with social media, or if you need funding for your next project. That's the stuff we're doing. So shout out to you, Ice. Big Stack. Let's go.
Let's go. Let's go. Listen, folks, we're at the top of the hour. You're in the P.I.L.L Method Club. And we're talking about not just paying off mortgages in 7 years, but we're talking about student loan larceny, how student loans have taken advantage of the fact that we don't know how loans work. In fact, we talked about students having their student loans they owe more now than when they graduated 10 or even 20 years ago, and they're still paying faithfully every single month. We just learned here that this student loan of $9,500, the bank wanted over $20,000 in interest, paying back a total of over $30,000 on this loan over 50 years, when all we had to do was come up with just $30.84 and prepay it. By prepaying it, we knock off a year. Folks, listen, If you like this kind of information, if you want to know how you can get rid of your student loans in 5 to 7 years, if you want to know how to get rid of your mortgage in 7 to 9 years and all your other debt, then what you want to do is go to the link above. Go to the link above. All right. And what happened? There it is. Go to the link above, click on that link, and then find where it says get a savings and earnings report. Follow all of the information. All right. So, folks, some people are just putting in their phone number and their zip code, and they think that's it. No, follow all of the directions. When you follow all of the directions, then the last button you're going to click is do you want to save now? By clicking on do you want to save now, then you can fill out our financial form. Put your student loans in, put your mortgages in, put your car loan or credit cards in, and we'll tell you how you can be out of debt in an average of 7 to 9 years. We're going to give you the month, day, and year you could be debt free and how much interest you could save. And with that interest saved, you can then what? You can then invest that and make a lot more interest. In fact, we're going to be talking about that on Sunday. You want to clip this because on Sunday, all right, I've already got it up. I've already got the show scheduled. So you want to find us, follow the club, and then go ahead and RSVP on that one for Sunday, because Sunday we're going to be talking about the 0% interest mortgage, the virtual 0% interest mortgage. I'm going to show you how to buy your house, all right, and fix it so virtually you pay no interest. You know, we talk about saving interest. I'm going to show you how to pay no interest on your mortgage. Miss Coffee Brown, did you hear that?
I'm over here saying, praise him. Come on, Pastor Don.
Coffee, listen, you keep jumping in there about the stuff that I say on this show, but have you ever heard me talk about the 0% interest mortgage?
You know, Don, you do a lot. So, you know, you do a lot, but one thing you haven't done is say the zero ministry. So this is going to be interesting.
So, folks, go ahead and sign up to make sure. So, while we got Coffee before she gets another phone call, Coffee, would you go ahead and introduce yourself this morning, please?
Absolutely. I am Coach P. Coffee Brown. I'm here in the great state of Texas by way of Houston. Please ignore the background noise. I am in transit to my team. I am a licensed risk management advisor by day, aka an insurance agent during the day, but by night I build wealth through two platforms. One is publishing, where we teach individuals, creators, collaborators, and entrepreneurs how to take the thoughts out of their mind and create publications that reach international audiences intentionally. We also teach them how to do it and not do it from scratch. We teach you the real cheat sheets on creating content in an accelerated rate for publishing purposes. I also have an online boutique, DFG Private Boutique LLC. You can find that located directly on Facebook. Lots of businesses. If you have not tapped into Facebook,
We lost her, folks.
on different websites
There
and
she
all
is.
that good stuff.
We lost you for about
Are
10
y'all able
seconds.
to hear me?
We lost you for about 10 seconds there.
We lost
Okay,
you
so
after you said Facebook.
oh Lord have mercy. But lots of creators are now using Facebook and Instagram for shopping purposes. So you need to tap into that. If you have a product or service, we can definitely, well, Stack will help you do that. Stack will help support you in that because he does that. But anyway, I am a certified master life coach with the John Maxwell method. So we definitely help you to do what you need to do in business and in your personal life. And I am excited to be here with Don to support the room. Don is phenomenal. If you're not following him, if you're not following the house, shame on you. Go ahead and make sure you follow so that you can go around all over Clubhouse where he curates conversation. He is a phenom in his own right, and he is a legend. He talks about other legends and other people, but he is a legend, and we're grateful to have him. So I yield the mic back over to you, Pastor Don.
Biz Coffee Brown, I tell you, in September, I'm going to be in Dallas. So I know I didn't get to see you while I was right there in Houston. But maybe, just maybe, I'm going to be there in Dallas a few days. Maybe we can hook up. What do you think?
Gotta come to my barbecue place. You got to meet me while I'm here.
Who got a barbecue place in Dallas?
I got 2 barbecue places in Dallas. One in Glen Heights and one in Dallas. This Dr. Barbecue.
Oh, cool. My daughter and several of my family live there. Don, yeah, let's do it, Don. Let's,
okay.
You know, I'm bougie, so I'm gonna fly. I'm gonna have to fly. I don't want to drive 2 hours.
All right then. All right, because I'm speaking at Uncle Al's event in September, and more information is going to be coming up about that. So, Miss Olivia, awesome. I see you on the stage. You raised your hand. What do you have to say to us this morning? Do you have a question or comment, Miss Olivia? Go ahead and click that microphone in the lower right-hand corner of your screen, and that will unmute your mic. Miss Olivia, are you there? Oh my goodness. Did I talk too long? Did I lose Miss Olivia? Miss Olivia, come on, ask your question. Well, listen, folks, while she's coming back, Coffee, I'm going to get you caught up. What we're just talking about is student loan larceny. And with this particular student loan, what I have on the screen is a $9,500 student loan. And with that, the bank, with this student has a $50 payment and it's only at 6% interest. But with that interest rate and paying $50 a month, it's going to take 50 years to pay this loan off. And the bank wants this student to pay $20,550 in interest. Oh my goodness. We just showed on the very first payment that only $2.50 goes to principal, while $47.50 of his money goes to interest. And it only gets better by 1 penny the next month. $2.51 goes to principal, $47.49 goes to interest. So in 1 year, Coffee, in 1 year, this student will have paid down his loan by only $30.84 and paid a total of $569.16 in interest. What do you say to that?
You know, Don, that's the devil, the whole devil. Just wrong. But you know what? So it's unfortunate that we didn't know this stuff before we signed up for these student loans and all that good stuff, and no one educated us on these things. So I'm just glad that you're here educating us so that we can right the wrongs that have been done as it pertains to our family. We can teach this to our students, and you know, Don, I'm looking forward to your testimony of this being a part of high school curriculum, a part of college basic knowledge and all that kind of stuff. So that's what I'm looking forward to, you adding this kind of value in the educational systems, because it's desperately needed.
Listen, everybody, you know, I need you to say, and I'm going to talk about something that's serious right about now. She's alluded to our church or me being a pastor. But let me tell you something. I do speak in churches. There's a program out there right now that's popular all over the country. We're not going to mention any names, right? But when it comes to debt and eliminating debt, there's one name that stands out above all others, and it's not the P.I.L.L method. Okay, very popular. I'm telling you, and I'm telling you the truth. When somebody discovers the P.I.L.L method and we come in and speak at their church, they never, ever invite the other person back. Never. So I'm looking for more speaking engagements. So if you want somebody to come to your church to teach you a better way to eliminate debt, then you want to contact the P.I.L.L method. So go ahead. Here's my 10K card, don10k.com, don10k.com, and then contact us to speak at your event, at your church, and we'll get it hooked up so people can get this information out there. Not only that, folks, but if you know people with student loans, share this video. It's going up on YouTube, on Facebook, on Twitter, on Instagram right now as we speak. So share the video with them, and it's titled Student Loan Larceny. So it's going to be easy to find. Get it out there to the folks. Get it out there to them. Miss Olivia, are you back yet? Flash your mic when you're back, okay? Because we want to get your question. And if you are trying and the app is glitching, go out of the room, come back in, and then we'll invite you back up, because that could be a problem as well. But folks, I want to show you, I want to go one step further. We're at prepaying, instead of paying $30.84 over 12 months. What if we paid the $30.84 in just 1 month? What would happen? We would be paid down to line 12 on this schedule immediately and save over $500 in interest. But I want to show you something else, folks. I'm going to the next screen here. All right. And if you're new to the room, and you want to see this, go to ice10kvideos.com and you'll be able to watch us on YouTube. And please click subscribe. All right. So once you do that, look what's happening here. Look what's happening. We have on there line 25 on the amortization schedule. In 25 months, that's 2 years and 1 month. 2 years and 1 month. This student, former student, would have paid this loan down by only $66.39 using the bank's method, and paid the bank over $1,183.61 in interest. And only $66.39 would have gone to principal, the money borrowed. Now that you understand this, could the student have made the $50 payment and got an extra $66.39 and applied it to this loan and knocked off 2 years worth of payments instantly and saved that $1,000 in interest they never would have to pay? Folks, I'm here to tell you. Listen, I don't know how much more emphasis I can get here. And I only have 18 shares. Come on, listen, I got to have at least 25 shares. Listen, the room is growing. We've got over 27 people in here right now. We have over 100 people have come through the room already. Let's get some more people in here so that they can see these numbers. I'm going to put a little math problem on the screen right now. And what we're talking about is $9,500. Okay, $9,500. And we're going to put $66.39 on this loan. It immediately gets us to $9,433.61. If we do it the bank's way, it would take us 25 months to get here. 25 months to get here, where we're only paying $66.39 towards the loan. But if we pay this all in 1 month, the $66.39, we knock off 25 payments immediately, and we get here in 1 month instead of 2 years. Do you see now why it is possible? Okay, let me go to the chat. Maybe something's in there. Do you see why now it is possible to knock off these loans in about 5 years instead of the 50 years that the bank wants you to be in these loans so they can get all this interest? Come on, folks. So all right, so we got another, Miss Cassandra says, financial aid offices need to go back to a person interest counseling. When a student applies for a student loan, this will help with understanding what you are signing up for. You're right. There should be classes on student loans, right? Because listen,
Hey Don,
Yes.
Don, before you move,
Yes.
before you move on,
Come on.
I'm getting ready to go into a 15-month program to finish up my master's degree real quick. What do you suggest? How do you suggest I address that for the student loan element of it?
Don't pay cash. Use the student loans.
You know what, Don? You know what? Lord have mercy.
So copy, because listen, I talked about that before you got to the room. All right. So I'm going to tell this story again. I'm going to tell this story again. All right. A doctor here in Huntsville was getting ready to write a check. They're on my program. They're getting ready to write a check to put their daughter through college here at Oakwood University. And I said, why don't you use student loans? He says, because I could write a check. I said, well, when do you have to pay back the student loans? He says, when she graduates. When do they start charging interest? When she graduates and they start the payment process. I said, then why couldn't you use the student loans, take the money you would have paid and put it in an investment? And then when she graduates, take the money out of the investment, pay off the student loans, and you keep all the money that money made in the investment. Miss Coffee Brown, what do you think about that?
You know what, Don? I'm going to talk to my daughter today. We're in the middle of this same scenario with my daughter. I was getting ready to pay for her school outright and just cut a check. And now listening to you, I'm like, because we really don't want her. My husband passed away years ago, and he did not want us to have any kind of debt for their education stuff. So they're set to be able to take care of it. But now that I'm listening to you, we need to re-explore that.
I think so. We need to take a look at how we can use that system to our benefit. Understand how that works. So I've got, I want to talk to my technician. We have some stuff in the chat that just does not need to be there. Can we complain to YouTube and put these people in timeout? Stop putting this stuff in here. So we want to report them as spammers, and it is obscene stuff too. So this is not good. So we want to take that out of our chat. Okay. Anyway, folks, so here's what we're talking about, folks. Coffee, you are exactly right. You are exactly right. We need to rethink this whole system on how we can borrow money and act like a bank. So banks borrow money. They lend out that money, or they get a big benefit for using that money, then pay us pennies on the dollars for the use of it. We can do the same thing. We can take the money we would have paid for the student, put that in an investment. It's there sitting safe as an investment. Okay. Not only that, but we could take it out of the investment after the child graduates or after we graduate, and then pay off the student loans en masse. And any monies that money would have made, you get to keep. Wow.
So Don, let me ask you another question.
Come on.
She's going to a non-traditional school. She's
Right.
going to trade school.
Okay.
And she'll be out of school in about 9 months, give or take.
Okay.
Because she's getting out of school quicker, that it won't be a long-term concept. So I need to just kind of find out what short-term investments, based on what you're saying, that we can dump the funds into.
Well, there's a couple of different ways you can take a look at this. Okay. Okay. One is we can look at this as something that we could do long term. All right. And here's one way to look at it. What if we took that money and put it into some sort of permanent life insurance for the child? Okay. But you control it as the parent. I mean, so it's under your control, but it is for them. And then you could take that money and jumpstart a permanent life insurance program for your child. And then after 9 months, it's something that can continue on. What you could do is we can pay that student loan back at a much lower interest cost And while you're paying the student loan back at a much lower interest cost, it'll only take a few months. They said, well, Don, we're going to be paying interest on that loan for that time. Yes, but the amount of money you can continue to put in your investment and or your permanent life insurance policy, you're going to make more interest than you're paying on the student loan. Wow. Listen, what did I just say? What did I just talk about? See, it does. See, we're talking about making interest and paying interest. So if I can pay interest and have an effective interest rate of about 1% or less, how do we figure effective interest rate? When you figure how much interest you actually will pay to pay off the loan, we can figure that for you. So when we figure out how much interest you actually will pay to pay off the loan, then we could figure what would the interest rate have to be to pay that small amount of interest. That's called the effective interest rate. So if you can bring your effective interest rate down to 1% or less, then take any monies you have then and put it into any extra monies and put it into an investment that's making 6, 7, 10, 12%. Why borrow money? Why pay something cash when you could borrow the money at 1% or less and take your cash and invest it? Miss Coffee Brown, does that help?
My God, I tell you, my God, that's all I can say, Don. That's all I can say. I'm gonna get with my financial advisor, and I'm gonna call Todd as soon as we get out of church here. I'm gonna call Todd.
After the benediction?
As soon as we say amen, that may the Lord watch
Between me and thee, while we're absent one from another.
Yeah.
Listen, sister, I need you to give me a call. So we need to talk some more. I love talking to you. Folks, do you see why we spend some time in these subjects and we talk about these things? Because we need people to understand what's going on with this. So here's what I need you to see, folks. We're going to put something else on the screen here. And when does it make sense? Okay. When does it make sense for you to stop building the bank's fortune by not understanding how all of this works and start building your family's financial legacy? What Ms. Coffee Brown was able to point out, ladies and gentlemen, it's not just about saving interest. It's about taking money that the bank is wanting you to pay them and invest that money in your future. Take that money and invest it in your future. It's about making money with your money, not just saving money. We're going to do both. Save money and make money simultaneously. So if the banks are making trillions of dollars off of interest, why can't we make a lot of money as well? Do you know we have average families, not investors' families, average families who are working a 9-to-5 W-2 jobs? We're showing them how not to pay interest and take the interest savings and invest it in their family and turning these families into millionaire families on a 9-to-5 with money they're no longer paying the bank. They invest that money into building generational wealth. And here's another thing for you. While you're building generational wealth, educate your children now on how money works really. And we have a book that will help you with that. And the reason why is that people who receive an inheritance, that money is soon gone in just a few months because they have an influx of all of this cash or inherit a business, and it is all gone in just a few months because they did not receive the education. One of the things that you can do is get my book. get my book and read it and pass it on to your children. And we are starting to work on book 2, where we get into specific strategies. Okay?
Come on, Don. Come on, Pastor.
That's what we're talking about. So, Credit Goddess, you have something to say. Do you have something to say about how second and third generation people lose all of their wealth that's been passed over to them because of a lack of education? Do you have something to say about that?
Oh no! Well, you said it all. That's pretty much what it is. I'm gonna quote what Queen said. There's 3 different mindsets. You have the poor mindset. Those that think that obtaining wealth is not for them, so they'll talk themselves out of opportunities, or talk themselves out of even applying. And then you have the rich mindset. Those are the ones that went out and go get it. They put in the work, they hustled, they put in the grind. And while they are celebrating their riches, they are not passing the information down to their family. And then you have the wealthy mindset. Those are the ones that have obtained the knowledge, that have done what was successful, and put a blueprint together to then pass it down to their children. Like you said, the lack of knowledge. And I think a lot of the times where we would hear parents that would say, no, I want my kids to work as hard as I did. They don't really have to work as hard. All you need to do is just share what you've done. But if you've hustled and grind and didn't document what you've done to actually get there, it's kind of hard to kind of pass that information down, because all you did was just put in the work, but we did not document. This is the documentation is what's important, which is why education is so important, because once we know the right information, we can then document that and then pass it down. But if we were getting it however we get it, then it's kind of hard to kind of pass that information down, because then we say, well, you got to put in the grind because I did. No, we have to know the education. We have to document that so we can pass that blueprint down. And wealth generation starts after the 3rd generation. So you are going to be that 1st generation to make that millions. Your 2nd, you'll be able to pass that down to your children. And tried and true, proven strategies are then applied at the 3rd generation, because you already done it now. You pass it down to your kids. Now they perfected it. Now they can pass that down to their children. So we have to start now. So I'm ending with that.
That's why
even the dog said amen. I heard the dog.
I heard that. I heard the amen corner back there. I heard it.
Listen here.
Come on.
Hey, Don, listen, before you go on, piggybacking off of what Credit just said,
Yeah.
This is the reason why it's imperative that we publish books. We're working with a teacher right now who had a strategy, and I love what she brought up, who had a strategy that worked for her in the initial years of her educating. And now she's going to produce a publication for new teachers. Same concept, guys. If you have, like she said, built out this incredible journey on business, not only teach your children, but you can literally teach the masses through publishing. Look at what Don is doing. Teach the masses. Don't even just think your immediate family, but teach the masses. Steve Jobs, he's got publication. Everybody that you can think of that is at that level, they have some form of a publication for you to be able to be educated on. And it is imperative that you do that. If you're a creator, a collaborator, or an entrepreneur in any capacity, even if you built a family business, you're still able to do a publication and leave that in the earth for many, many hundreds and hundreds of years after you're gone, for your family to have that blueprint of success. I yield back to you.
Thank you very much for that. That's why we're working on book 2, ladies and gentlemen. We're working on book 2 so people can we can get down and drill down into some specific strategies. And folks, it's more than just paying extra. It's more than just people have been saying, just pay extra on your loans. I got people that come to me that make mention of us, what we're doing here online. And they said, Don, why are you trying to make it so difficult? All you got to do is pay more. Yeah. If that was it, then why is it that 9 out of 10 people will never be out of debt? Because it's more complicated than that. It's more complicated than that. When does it make sense for you to stop building your bank's fortune and start building your family's financial legacy? Why? Because they have a system in place that uses math and timing to make trillions of dollars. Okay? They're playing chess while we're learning how to play checkers. So why in the world would we ever try to go up against the banks using their supercomputers, and we have a pen and paper, a pencil and paper, trying to beat the banks at their own game? They've been doing this game, folks. They've been doing this game since 1934, amortizing these loans. And for some of you, even if you've been in the financial industry, for some of you, this is the first time you're hearing any of this information, even with your degrees. So why is that? How are we expected to play a game we don't have the rules to? Okay? Because let me show you something. Because every time you figure out what to do here, let me put this on the screen. Every time you start to figure out what to do, you learn more and more and more. What we're talking about here now is when you have variables involved in anything that you do, then you got to figure out, what order do I pay the loans off? Did you know the average family has 13 different loans? Did you know that we have not only 13 different loans, but we have various amounts of money that we could put on the loan? And then we have to choose which day to do it because of the timing that's involved. So when you look at all the things that you have to consider, what sequence do you put all of that together to save the most amount of money? I want to show you something that when you only have one choice to make, then that's great. You only have one choice. When there are two choices between two things, there's only two ways to look at it. You can do it this way or that way. One of them is going to be better than the other. When you have three choices to make, now you have 6 different ways to look at it. Now, one of the 6 is optimum. It's going to save you money, and the other 5 are going to lose money. Did you know when it comes to lending, there are at least 10 variables that we've identified that you have to consider when paying off the debt? 10. Let me show you something. When you only have 6 variables, there's 720 different ways to look at what you have to do to find the one right way to do it. When you have 10 variables, that's 3,628,800 different ways to take a look at your debt and see how to pay it off so you can save the most amount of interest that's mathematically possible. I am so tired of people saying, all you have to do is. All you have to do is, when you're guessing, is lose money and give your money to the bank. That's what you are. That's what you do when you're just guessing and you don't know what to do. And that's what they are depending on. That's what the banks are depending on. You never learn how to read this thing. And Coffee, you better stop calling me pastor, because then you make me start. Then you make me start talking like this. Stop it.
Come on now. Go ahead and preach. Go on down.
So 10 different ways. You got 3 million different ways to look at it, and only one of them is optimum. Which one is it going to be? Now, who's going to do all of that math for you? Who's going to do all that math for you? We will. It's called computerized optimization. You have put all of your debt in it. What you're looking at, folks, what you're looking at on your screen right now is a program that you can put all of your debt in. They've got a mortgage in here. They have a student loan in here. They've got credit cards. They got everything in here, and they're going to save. We're going to show them. You see it up here in the upper right-hand corner where they're going to save $179,000 in interest they won't have to pay. Therefore, they're going to be able to pay off all of their debt in 7.8 years instead of 30 years with their current budget. And they're still able to go on vacation every year and have fun every single month. Have fun in their family every single month. Go on vacation every year, maybe even 2. Still get out of debt in 7.8 years. by saving $179,437.89 in interest they will not have to pay. And we'll show you what happens when you don't have to pay all of that interest. So let's take a look at another screen. So here's what you can see. Here's what we have here. If you're new to the room and you want to see this, we're at 24 shares. Thank you very much for 24 shares. Keep sharing the room. We have 31 people in here now. If you want to see this, go to ice10kvideos.com, ice10kvideos.com. And since we haven't done a reset in a while, we're going to reset right now. Okay? We're going to reset right now. And go ahead up to the top of the room, click that green mansion and follow the P.I.L.L Method Club if you found this information to be insightful, to be important to you. Go ahead and follow me, and then go ahead and click always so that whenever I'm in a room, you can know and get this valuable information. All right. Also, we want you to hear from, if you're new to the room, I want you to hear from someone who is quite famous that has paid off their mortgage in just 4 years. In fact, I'm going to debut. You're going to be the first ones to see my brand new television commercial on Sunday that talks about, that shows this gentleman who paid off his mortgage in just 4 years with this program. Let's hear from Dr. Eric Thomas. Yes, it's your boy E.T. up in the house. Go ahead and play it.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm going to keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't got to do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
Did you hear that, folks? Dr. Eric Thomas paid off his mortgage in under 4 years. And why did somebody who makes that kind of money, why would they use a mortgage anyway? We were just talking about that. Because he could borrow money for a lot less interest by using this program and then take his money and invest it. Why take money out of an investment that's making 10 to 15% when you could borrow money and pay 1% or less on the borrowed money? That's your effective interest rate. Take a look. We're back on the screen now. We're back on the screen. So here's what we have, folks. John and Rebecca Jones here have $500 in their checking account. They have over $5,000 in savings. So, and they've got a $25,000 auto loan. They have $2,000 on the Visa. They have a $200,000 mortgage at 6%. They're going to be able to pay all of that off in just 7.8 years by not changing their budget. Wow. So here's what we go. So here's what we're looking at, folks. You see these little arrows here? These little arrows tell us what to do. Once you put everything in your program, the little arrows that you see here says, okay, if we take a look at, I've got February 6, 2015 here, but if we take the arrows and follow the arrows, it says take money from your checking and put it in your savings account, $2,550.88. Take $2,000 and pay off the Visa out of the savings account and put another $678 on the first mortgage. These little arrows tell you what to do and when out of monies that you're saving, not out of your budget. The monies go into savings after you pay all of your bills and you've had your fun with your family. Look here, I want to show you what happens when you pay off this credit card this way. You see here in the left hand, about center left, Future interest savings, $1,951.16. By paying off the credit card this way, instead of keeping the money in the bank. Do you know I was talking to somebody just the other day? Oh, listen, this is priceless. I'm talking to somebody the other day and they wanted to sit down. Can I talk to you about how to pay off my credit cards? And I said, okay. And I said, first, I need you to look up the word fungible, Fungible, fungible. All your funds are fungible, meaning they're interchangeable. The money you can purchase out of your purse and the money you can purchase on your credit card, $1 on your credit card buys $1 worth of stuff. $1 out of your purse buys $1 worth of stuff. All right. And I said, well, she wanted to know, why do you want to do that? I said, because a lot of people, because of how they've been taught, listen to this now, because of how they've been taught, they keep a lot of money in their savings account for emergencies while they're carrying a balance on the credit card. Let me ask you a question. This is what I asked her. If you have $10,000 in your savings account, that means you have $10,000 you could potentially spend, correct? This is yes. I said, if you owe $5,000 on your credit card and you're trying to use like the snowball method where you put a little bit extra on there every month and pay it off, you're going to pay it off faster by using the snowball method. That's right. And I said, here's what I'm asking you. If you take, you have your $10,000 in your savings account and you take $5,000 out of your savings account and pay off the credit card to zero, how much money do you have available to spend? Think about it. I had $10,000 in the bank. I took $5,000 out of the bank, paid off the credit card to zero. How much money do you still have available to spend? The answer is $10,000. I've got $5,000 in the bank. I've got $5,000 on the card. I can still spend $10,000 if I have to. But guess what just happened? Okay. I am not paying. Let me go back to the previous one here. Let me go back a couple here. You see the interest rate on this is 21%. If I owe $5,000 on my credit card, I'm paying 21% on it. If I pay it off, I stop paying 21%. It's like getting a raise. A penny saved is a penny earned. 21% saved is 21% earned, folks. So you instantly get a raise by paying off the card. If you like looking at your money in the bank, where you're making 0.1%, you're paying 21% in order to keep your money in the bank. Take the money out of the bank, pay off the credit card, save the 21%, and you still have $10,000 available to spend. It's all fungible. Look at that. You just want to have your money available to you. It's still available to you on the credit card. You still have $5,000 available to you. And the time that you're not using the credit card, you're saving the interest. And if you have to use the credit card, we're going to show you how to cut your interest cost on that card by 75%. I don't care what the interest rate is. I don't care about interest rate. I only care about interest cost. So, folks, this is what we're talking about here. All right. So we've got what about 8:54. So we got a few minutes left. So let's get into this thing. I want to show you that by paying the extra on this, if you want to see what we're having, if you're new to the room, please go to ice10kvideos.com so you can see it, or watch the replays later on YouTube, Facebook, and Twitter, and LinkedIn. You can watch all of that, all of what we're doing today. So we just showed what would happen if we paid the extra money to the credit card. Watch this. If on this mortgage, if we put $678.09 on principal, look at what happens to this mortgage. That means we will not have to pay $3,321.05 in interest by taking money out of the bank, making 1/10 of 1%, applying $678 to the mortgage or your student loan, and look at how much interest you save. We show you how much interest you save. Now, why is that important? Why is that important? And I'm going to shut it all down. Why is it important to understand interest cost instead of interest rate? Why is it important to know how much interest you save when you prepay? Here's why. As long as you've been alive, as long as you've been handling debt, as long as you've been paying extra on your loans, the bank has never, ever, 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 ever given you a receipt that said, here's how much interest you saved because you paid us extra, put extra on this bill to pay it off faster. They've never told you how much interest you've paid, how much interest you saved. Do you see the difference of why we want to make sure which loan we're paying off, no matter what the interest rate is? We want to know what the interest cost is, because paying $600 off on the credit card just so that you can, let's say you only owe $678.09 on your credit card. And you say, I never pay credit card interest because it's at 30%. I'm trying to tell you folks, 30% on $678, it's peanuts when you figure out the daily interest. But by putting $678 on the mortgage, you save $3,300 in interest. It matters how you look at the sequence of paying off the loans. All of this is important to know. So, folks, I want to make sure that you know that there is a technology right now that is super advanced, that's going to give you that financial advantage on paying off your student loans, on your mortgage, on everything else you're looking at. And it's the P.I.L.L method opportunity cost calculator. Go here right now. Go here right now. Go to the top of the page. Okay, we're done with our demonstration. Let's go to the top of the page. Let's take a look at how to get a savings and earnings report. How to get your savings and earnings report so that you can know the month, day, and year you can be debt free. Oh my gosh. So how can we do that? You can fill out our information to get a savings and earnings report, and you will know the month, day, and year you can be debt free. Wow. I want you to know that we are here to make sure that you could be debt free, that you learn the rules to the game, that all of this thing that we're talking about, it gets very complicated after a while, but someone has put it all together in a nice, neat package. All you have to do is put in your information and the computer does the work. You just follow the computer. If you want that for yourself, for your family, and you'll have it for a lifetime, for mortgage after mortgage. You know, I got families that are paying off their third and fourth mortgage. I mean, they get to use this thing over and over and over again. So, folks, I want to say goodbye to everybody online. All right. Goodbye to everybody online. Be back here on Sunday, where we're going to be talking about the virtual 0% interest mortgage. Let's hear from Dr. Eric Thomas one more time as we say goodbye to everybody online. We're going to come back and do our moderator outros on Clubhouse. See ya.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down from my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.